Hello, America! Today we're diving into the thrilling world of monetary policy, a topic that might seem dry but is actually full of drama and intrigue. At the heart of this is the Federal Reserve, or as I like to call it, the economy whisperer. This institution holds immense power over our financial lives. They have this tricky job of keeping our economy humming along nicely, balancing growth and stability. Think of it like trying to keep a toddler entertained on a transatlantic flight. Too much stimulation and they'll be bouncing off the walls, inflation. Too little and they'll throw a tantrum, recession. It's a delicate balancing act that requires constant attention and adjustment. Right now the Fed is facing a real head-scratcher. Will they cut interest rates in 2025? This decision is not just about numbers, it's about the future of our economy. These rates are a big deal because they affect how much it costs to borrow money, influencing everything from personal loans to business investments. The Fed's decision will have a ripple effect on everything from your mortgage to the price of that avocado toast you love so much. It's all interconnected in this vast economic web. So buckle up, dear viewers, as we unpack this economic puzzle and try to figure out what the heck is going on. The stakes are high and the outcome will impact us all. Remember the good old days of 2022? Inflation was running rampant and everything was more expensive than a trip to Disneyland. The Fed decided to step in and play the role of economic party pooper. They started hiking up interest rates like nobody's business. By making it more expensive to borrow money, people started to think twice about buying that new car or investing in their Beanie Baby collection. Demand cooled down and inflation started to ease up. But now the question is, have they done enough? Are we out of the economic woods yet? Let's investigate, shall we? So how's the economy looking these days? Well, it's complicated. On the one hand, inflation has calmed down from its 2022 high. The job market is also looking pretty good. Unemployment is down, which means more people are working and contributing to the economy. However, inflation is still above the Fed's target. It's like that lingering smell of smoke in your apartment. You think it's gone, but then you open your sock drawer and bam! You're hit with the pungent aroma of burnt dreams. Basically, the economy is sending us mixed signals. It's like trying to read your horoscope while drunk. You want to believe it's telling you something profound, but in reality, it's just a bunch of vague nonsense. So what's the real story? Let's dig deeper. In the world of economics, all eyes are on Jerome Powell, the enigmatic leader of the Federal Reserve. He's like the economic equivalent of a magic 8-ball. Everyone wants to know what he's thinking, but his pronouncements are often as clear as mud. Back in December 2024, Powell gave a big speech that left everyone scratching their heads. He hinted that rate cuts were possible in 2025, but emphasized that everything depended on the economic data. Powell's basically saying that the Fed is playing it by ear. They're watching the economy like a hawk, ready to swoop in and adjust interest rates if things start to go south. The problem is, no one knows what they consider south. So, what does this mean for us? Basically, we're all stuck in a holding pattern, waiting for the Fed to make up its mind. Okay, let's get down to brass tacks. What does a rate cut really mean for the average person? It's not just a headline on the financial news, it has real-world implications. What would a rate cut actually mean for you, the average American who just wants to afford a decent cup of coffee and maybe a vacation that doesn't involve sleeping in your car? It's about making everyday life a bit more affordable. Well, for starters, lower interest rates usually mean it's cheaper to borrow money. This can affect everything from your mortgage to your car loan. That means lower mortgage rates, which could be good news for anyone looking to buy a house or refinance their current one. Imagine saving hundreds, if not thousands, over the life of your loan. Lower rates could also give the stock market a little boost. Investors often get more optimistic when borrowing costs are low, leading to increased market activity. When borrowing is cheaper, companies tend to invest more, which can lead to higher profits, and, in theory, higher stock prices. This can be a boon for your 401k or investment portfolio. But here's the catch: rate cuts can also lead to inflation. When money is cheaper to borrow, people and businesses tend to spend more, which can drive up prices. So yeah, rate cuts are a bit of a double-edged sword. They can stimulate the economy but also lead to higher prices for goods and services. It's like trying to juggle chainsaws. Sure, it looks impressive, but there's a high probability of something going horribly wrong. Balancing the benefits and risks is crucial for both policymakers and everyday people. When it comes to predicting the Fed's next move, even the experts can't seem to agree. Some folks, like the smarty pants over at Goldman Sachs, are predicting a couple of rate cuts by mid-2025. Then you've got other economists who are a bit more cautious. They're worried that cutting rates too soon could reignite inflation, and we'll be right back to where we started. And then there are those who think the Fed might actually raise rates again. They're the economic equivalent of that friend who always brings a raincoat to a picnic. They're prepared for the worst-case scenario. So who's right? Honestly, your guess is as good as mine. The economy is a complex beast, and even the experts don't have all the answers. So, what does all this mean for you, the average Joe or Jane trying to make ends meet? In these uncertain times, managing your finances can feel like a daunting task. Well, the truth is, no one knows for sure what the future holds. The economic landscape is constantly shifting, and predicting it is like trying to read a crystal ball. The best thing you can do is be prepared. Planning ahead can make a world of difference. That means having a budget, a clear plan for your income and expenses. Saving for a rainy day, because unexpected expenses can pop up at any time, and maybe investing in a really good stress ball. Stress management is key when dealing with financial pressures. If the Fed does cut interest rates, it could be a good time to refinance your mortgage or consolidate your debt. Lower rates can mean significant savings over time. But don't go crazy with spending. It's important to resist the urge to splurge, even when it feels like you have a bit more breathing room. Remember, inflation is still a thing. Prices for everyday items can rise, affecting your purchasing power. On the other hand, if the Fed decides to keep rates high or even raise them, borrowing costs will increase. You'll want to be extra careful with your spending. Every dollar counts, and careful planning is essential. The bottom line is, we're all along for the ride on this economic roller coaster. The ups and downs are inevitable. Buckle up, hold on tight, and prepare for the unexpected. And try not to throw up on the person next to you. It's a wild ride, but with careful planning, you can navigate it successfully.